Yes, so we are told that 𝗨𝐿𝐺 Limited is a public listed company. Details of the company statement of financial position as at 31st of March 2022 and 31st of March 2023 are shown below, together with other relevant information. So we have the statement of financial position as at the 31st of March 2023 and 2022. Remember what we said is that anytime you're given a question for cash flows, you will always be given the statement of financial position for the previous year and the current year. And we say the figures in the statement of financial position for the previous year are the opening balances, while the figures in the statement of financial position for the current year are the closing balances. So in that statement of financial position one, we are given the non-current assets, which include PPE, property, plant, and equipment, intangible asset. Then we have the current asset, which include inventory, trade receivables, interest receivable, short-term deposits, and then we have the bank balance. Under share capital and reserves, we have ordinary share capital, and then under reserves, we have share premium, revaluation reserve, retained earnings. And then from there, we have non-current liabilities, which include 12% loan notes, 8% variable rate loan notes, and then we have the deferred tax. Under the current liabilities, we have trade payables, bank overdraft, and then we have what? Taxation. And then from there, we have some additional information, number 1, number 2, up to note number 6. We are going to go through those particular additional information as we see whether there are some workings which are required. And then what we are required down there is we prepare a statement of cash flows for 𝗨𝐺 Limited for the year which ended 31st of March 2023 in line with International Accounting Standard number 7. International Accounting Standard number what? 7. So what we need to do here is basically we go through the additional information as we see whether there are some workings which are required. And equally, you can see in this question, the examiner has not specified which method to use. But what we say is that once you're given the statement of financial position and the income statement, we said always use the indirect method. Use the indirect what? Method. You can see under the first paragraph, we have the statement of financial position of this company. And then if you go down there, I definitely hope you have tried to go through this particular question because we had agreed on the same. You attempt the question before we meet. If you go to note number 4, you will see that you are given the statement of profit or loss. So basically, that is now the income statement. So automatically, what that means that in this particular question, we are going to apply the indirect method. We are going to prepare a statement of cash flows using the indirect what? Method. So let's start with the additional information. Number 1, you see what we are told. We are told that details of property, plant, and equipment is at 31st of March 2023, which is now the end of the current year, and 31st March 2022, that is now at the start, are given down there. So what we are given for each year, we are given the cost stroke valuation, the depreciation, and then the carrying amount. Carrying amount, you have to remember, is the same with what? The net book value. The difference between the cost and the depreciation. And then we are given the same details for the year 2022, cost, depreciation, and the carrying amount of the net book value. And then PPE there comprised of 2 assets. It's comprised of land and buildings, and then you are given the plant. And basically, in each of the year, we are given 3 items: the cost, depreciation, and also what? The net book value. And then down there, we are also given the total net book value at the start and also at the end. So as far as this point, or at this point, no working we can do as far as that is concerned. And let's first of all, we go to note number 2. We see what we are told. In note number 2, we are told the company revalued the carrying amount of land and building by an increase. The company revalued the carrying amount of land and building by an increase of 70 million on 1st of April 2022. So basically what you are told here in that point is that this company revalued revalued land and buildings, and you can see when the revaluation took place. The revaluation took place on 1st of April 2022. Now, automatically 1st April 2022 is the start of the current year, 1st of April 2022, because you can see the current year ended on 31st of March 2023. And remember what we said is that once the company revalue assets at the start of the year, once we have assets which have been revalued at the start of the year, then we say that the depreciation for the current financial year will have to be computed based on the revalued amount, based on the revalued what? Amount. And also those particular assets which have been revalued, they will be recorded now in the company statement of financial position at the revalued amount. So the previous values, that is the previous carrying amount, now will be ignored, such that such an asset which has been revalued will be recorded in the company's books of account, in the company statement of financial position at the revalued amount. So therefore, there was a revaluation of land and building, and you're told there was an increase of 70 million, which automatically is a revaluation gain. And then you're told on 31st of March 2023, that is now when the year was coming to an end, shillings 3 million was transferred from revaluation reserve to retained earnings relating to depreciation on revaluation of building. So basically, this 3 million is an amount which was transferred from the revaluation reserve. The revaluation reserve reduced with 3 million, and then the retained earnings increased with how much? With 3 million. But this amount here of 3 million, there is no way we are going to take it into account in preparing our statement of cash flow, because this is purely an non-cash item, just like the revaluation gain of 70 million is a non-cash item. Sasa? Yes. So no working equally, which is required there. Number 3, we are told during the year the company acquired a new plant at a cost of 60 million. So this new plant which was acquired, automatically this would be considered when computing the cash flow from investing activities, because we said when determining the cash flow from financing activities, sorry, not financing, rather investing activities, we consider the asset which were acquired and the asset which were disposed. So therefore, we're going to take into account that 60 million when determining the cash flow from investing activities. And as sold some old plant for shillings 15 million, incurring a loss of 12 million. So in that case, we are told there was an item of plant, or basically there was an old plant which was disposed. If you check on what you're given there, as far as that plant which was disposed is concerned, we are given the amount at which it was sold at, that is 15 million. This 15 million one, when preparing our cash flow and computing the cash flow from investing activities, we are going to take it into account as what? As a cash inflow from investing activities. This is money received from selling an old plant. And then also when computing the CFO, the net cash flow from operating activities, we are going to take into account the loss which is given there. How much is that? Is 12 million. But if you take on that particular point, there is something we are not given here. This item which was disposed, we are not given its cost, and equally, we are not given its accumulated depreciation. We are just given two values. We are given the sales proceeds and the loss on disposal, because remember what we said here, once an asset has been disposed, you have to prepare an account called what? The disposal account. You determine the gain or loss on what? Disposal. But in our case here, you can see we are given the loss. Anytime you see the examiner having given you the loss or gain on disposal, automatically there's something which will not have been given, and therefore you have to prepare the disposal account to determine the item which you are not given. Here you can see we are not given two values, the accumulated depreciation and what? And the cost of that particular what? Plant. But I think we can first of all have that particular account here, though we are not given all the items required. So we have some workings. So let's start with the disposal account. Disposal account, and this is the disposal account for plant. Disposal account for plant. So in terms of how we prepare this particular account, on the debit side, we should have the cost. Then on the credit side, we have what? The accumulated depreciation, the sales proceeds, And then we said we balance the account. A balancing figure on this side is a gain or a profit on disposal. But in our case, we are told this item was disposed at a loss, which should be the balancing figure on the credit side. And the loss is what? Is 12 million. And for us to be consistent, we are going to work with all our figures in million of shillings. Sasa? Yes. So there was a loss of 12 million that is already given. We also given the sales proceeds. We are told that item was disposed at 15 million. At 15 what? Million. So we already have that. But you can see now in our case, we are not given that accumulated depreciation. We are the equal not given the cost. So I'll show you how we are going to determine those particular two values. Those two values, the accumulated depreciation and also what? The cost. But let's first of all move to, no, do we need to move to the other point? First of all, no. So before we go to point number 4, I want us to go back to point number 1 because there are a number of things we need to prepare there. The number of accounts. This question was a little bit tricky as far as point number 1 is concerned. As far as number 1 is concerned. So now, as far as the land and building are concerned, land and buildings are concerned, what you're going to do, we need to prepare that account first of all. The account for land and building, we determine, well, there are some land and buildings which were acquired during the current year, because as far as land and buildings are concerned, we know that there was a revaluation, and there was a revaluation gain of 70 million as per note number 2. But as far as land and buildings are concerned, we don't have disposal, because if you go through note number 4, note number 5, there is no any information given about land and building. So therefore, there was no what? Therefore, there was no the disposal of land and what? Building. So therefore, let's start by preparing that particular account there for land and buildings. And I've said that the objective of preparing this account is for us to determine, were there some land and buildings which were acquired during the current year? Which were acquired during the current year. So what we start with here is the value for land and buildings at the start of the year. At the start of the year. And in this case, we are going to record now the value of these particular land and buildings at net book value. What was the net book value for land and buildings at the start of the year? The value, the net book value for land and buildings at the start. You can see that figure in note number 1. Net book value for land and buildings at the start. Remember, the start is the year 2022. The closing is the year 2023. Jackie is not 770. I don't know whether you're getting that 770. So how much is that figure? It is 420. It is for what? 20. So why are we recording this or why are we recording the net book value here? Remember what we said. There is something we covered in the topic of published. We say that if you revalue assets and that asset was previously being depreciated and you want to determine whether there was a gain or a loss, what you do is that you compare the net book value of that asset, not the cost. It's net book value with the revalued amount. There is a question we did for published, whereby some buildings were revalued, and therefore we say that in determining the revaluation gain or loss, you take the revalued amount. You don't compare that with the cost, but you compare that with the net book value, because at the time that asset was being revalued, its value was net book value, not the cost, because it was being what? Depreciated. But we said if an asset which is revalued is not a depreciable asset like land, you compare the revalued amount with what? With the cost. With what? The cost. So therefore, that's why we are recording the opening balance here. The opening balance here as the net book value, So we have 420, and also we have the value for land and buildings at the end of the year, which is 600, which is 600. Then we go back to note number 2. In note number 2, we know that these land and buildings were revalued upward, and they were revalued with an amount of how much? Who can give us that value? Are revalued with an amount of how much? What was the revaluation gain on land and buildings? In note number 2, Yes, I'm told that is a figure of 70. So the revaluation gain, which increases the value of the asset, that should be recorded in this account. Should be recorded in this what? Account on the debit side. On the debit what? Side. Then the other thing which is also important before we balance this particular account is that depreciation for landed buildings should be computed based on the revalued amount. And basically what we do is that once we have revalued assets, then we ignore any previous accumulated depreciation. Any previous accumulated depreciation, we do what? We ignore it, because during the current year, we compute the depreciation based on the revalued amount. So therefore, as far as the landed buildings are concerned, the depreciation for the current year is the figure we have in note 1. If you go to the note 1, in the year 2023, can you see that depreciation of 12? That depreciation of 12 for landed building, that is now the what? The depreciation for the current year. The depreciation for the current what? Year. But that amount, we don't need to record it here. We don't need to record it what? Here. Sasa? Yes. So basically what now we need to do is basically to balance this account. Remember in this case, we have said here there was no what? There was no disposal. There was no what? A disposal. So what we need to do, we balance this particular account and you give me the balancing figure. 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 Okay, in this case, there are two things you can do. I can see some people asking about why the balancing figure here is not 588. So I think there is something I've mentioned here about what? About that particular depreciation. So in this case, you can record the closing balance here as 558. And then I think you also record the depreciation here. You also record the depreciation what? Here. So just the same thing that on this side, I think let's just do that, because that's what you have been doing. We record the closing balance there as 588. And then we record the depreciation for the current year here, 12, which by the end of the day will give us what? I think that should be 600. Is that the case? Yes, but in this case, if you decide to prepare this particular, if you record this account, or if you record 600 here, then we don't credit depreciation here. If you are preparing this account at what? At cost. But let's just do it like that. We record the net book value there, 588, and then we also have depreciation there. Sasa? Yes. So I hope that is now clear. Is it clear now? The person was asking that question, why we are not recording the closing balance as 588. I hope that is clear now. Record that 588 and also depreciation of 12. Sasa? And then you give me the balancing figure now. The balancing figure will be how much? Yes, it will be 110, and that will be on the debit side. Now this 110, what is it? Who can tell us? What is that figure of 110? That 110 is what? That 110 on the debit side. Yes, so these automatically are acquisitions. These are automatically acquisitions. All acquisitions. These are acquisitions. These are landed buildings which were acquired during the current year. Which were acquired during the current what? Year. So one of the confusing point in this particular point, or basically one of the tricky part as far as land and buildings were concerned, most of the students were not able to know that that figure of 12 million, this is the depreciation for the current year. Most of the students treated that as accumulated depreciation at the end, which is not the case, because you have said once the assets have been revalued at the start, then what we do is that we will compute the depreciation for the current year based on the revalued what amount. And I think we are done with that. So therefore here, as far as landed buildings are concerned, in preparing our statement of cash flow, you're going to consider a number of items. One, the landed buildings which were acquired as part of the investing activities. Depreciation, we adjust it now in our what? In our profit, or basically in our loss. Yes, I think those are the two items you're going to do what? To consider. Then I want us still, we prepare now, we deal with the plant because the PP also included the plant. But now we know that these plant were not revalued. Were not what? Revalued. So also, or basically as far as the plant are concerned, we are going to prepare two accounts here. One, we are going to prepare the plant account at cost. We're going to prepare the plant account at what? At cost. And then we also prepare the accumulated depreciation account for plant, because for plant, we don't have the depreciation for the current year. Now, in this case, the depreciation which we have there in the year 2023 for plant, 148, this is the accumulated depreciation at the start. And then the depreciation which we have in the year 2022 is the accumulated depreciation at the start of the year. 105 is at the start, 148 is at the end. So what we are going to do here, we're going to prepare two accounts. The plant account at cost, basically to determine the balancing figure, which we shall bring here, because as far as plant are concerned, we're given the plant which were acquired, and then we prepare the accumulated depreciation account. So let's prepare those two accounts. We first of all start with the plant account. Plant account, and I've said we are going to prepare this account at cost, and then we prepare the what? The accumulated depreciation account. Accumulated depreciation what? Account. Accumulated depreciation on plant account. So let's start by preparing this account, and I've said we prepare this account at cost. So we start by taking the cost of plant at the start. At the start. So the cost of plant at the start, I hope you can see that is the cost. The cost is 445 at the start. I hope you can see that in note 1. And then the cost at the end of the year, the cost at the end of the year is what? Is 440. Is 440. I hope you can see those figures. Cost at the start, cost at the end. Then equally, let's record the accumulated depreciation at the start, and accumulated depreciation do have a credit balance. The accumulated depreciation at the start was 105. The accumulated depreciation at the end of the year was how much? Was 148. Was 148. 148. So that's what, first of all, we record. Then what else will be affecting this particular account? One, as far as the plant are concerned, we know that there were plant which were acquired, because what we record in this account here is any revaluation gain, which we know that there was, these plant were not revalued. Any revaluation loss should be credited here, but there was no revaluation. And then what we also record here is the disposal. And take into account this particular account, we have prepared it at cost. The plant which were disposed should be credited in this account still at cost. And remember, that is a figure which is missing here. So most likely, that would be the balancing figure in this particular what? Account. Sasa? Yes. So therefore, what we need to do, can we go to note number 3? In note number 3, we are given the plant which was acquired. So once we have plant which has been acquired, acquisition, that should be debited in this account. The plant acquired at a cost of 60 million. 60 million. And also we know that there was a plant which was disposed. And as far as that plant which was disposed is concerned, we only given it accumulated, the sales proceeds and the loss on disposal. The loss on disposal. The loss on disposal. I'm given a figure of, no, Jackie, remember you have said we are preparing the plant account at cost. At cost. I've taken the cost of plant at the start. I hope you can see the cost and the net book values. The cost at the start is 445. That is the cost. The cost at the end is 440. I've said once you prepare this account at cost, you also have to prepare the accumulated depreciation account. Sasa, but if you prepare this account at net book value, you don't need to have to prepare this account. But we need to prepare this particular account at cost because we are not given the cost of this plant which was disposed, which automatically would be the balancing figure here. Sasa, Yes. Yes. So I'm saying this question was a little bit tricky as far as note 1 is concerned from the other questions which I've already tackled on cash flow. So what we need to do here, we need to balance this particular account, and the balancing figure here represent the cost of this plant which was disposed. So what will be the balancing figure here? We just need to get the total on the debit side, which will be 505 minus what we have on the credit for 40. That will give us what? That will give us what? That will give us what? Is the balancing figure here 65? Is the balancing figure there 65? 65. I need to get these figures from you. I need to get these figures from you. Is it 65? Yes. So this 65 represents the cost of this plant which was disposed. And therefore, we need to record that here because this cost of the plant which was disposed was not given, but now we have it. Sasa, then we need to come to this particular account. Now, what do we record in this account? 2 items, other than the opening and the closing balance. On this side, we have now the depreciation for the current year, which was taken to the income statement. Depreciation for the current year taken to the income statement. We don't have that. And then what we record on the debit side is the accumulated depreciation of the asset disposed. In our case, we know there was a plant which was disposed. Were we given it accumulated depreciation? No, we don't have it. But now you can see what is only missing in this particular account is this figure here. So what that means automatically is that the balancing figure in this particular account here will represent the accumulated depreciation on this item of plant which was disposed. So we bring it here, and then we balance our account by determining the depreciation for the year. Are we together? Yes. Can we do that? Let's first of all get the balancing figure in that account up there. So you can see the total on the debit side is more with 65 million. And then what we have on the credit is 27 million. So what will be the balancing figure? The balancing figure here is what? Is 38. That now represents the accumulated depreciation of this plant which was disposed, which we have said in this account, it should be what? It should be debited. And then what do we do now? What is missing here is the depreciation for the current year for what? For plant. Can you get now the balancing figure here? You can see now the question has become simple, though I'm saying those accounts are a little bit tricky to most of the students. Yes, so you get the balancing figure, you get the total on the debit side, 38 plus 148, minus what we have on this side. Minus what we have on this side, 105. 105, 105. I'm given 43, 81. Yes, so majority are giving me 81. So that is what? The depreciation for the current year for what? For plant. So that is another item we are going to consider in computing our CFO, in computing our net cash flow from what? Operating activities. We add it back to the profit. I think we are done with that. Note 1, 2, and 3. But you can see those notes had some few workings there. So in the note number 4, what you are told is that the following is the statement of profit or loss extract for the year which ended 31st of March 2023. So we're given the statement of profit or loss extract. So we have the operating losses, interest receivable. Remember, interest receivable is the same with investment income. This is what I said. Interest received is a form of an investment income. And then we have the finance cost. And then we have the loss before tax. So mean that this company is operating at losses. Is operating at what? Losses. And therefore, remember what we said is that when computing the CFO, we have been starting, or we said always start with the profit before tax. So what we are going to start with, as far as this question is concerned, we are going to start with the loss before tax. And then we adjust that loss with a number of what? Items. Then below that we have income tax repayment claim. And then we have the deferred tax charges. And then we have the loss for the period. And then we are told the finance cost are made up of interest expense of 18 and penalty on early redemption. So when we talk about penalty on early redemption, whenever the company is redeeming some debt instrument, the debt instrument must be redeemed on the time the company agreed with the debt holders. But if the company redeems them earlier, the company may be required to pay a penalty. And that penalty is always accounted for as an expense, but this penalty paid on redemption, on early redemption, is not an operating expense. So therefore, what we do is that we also add it back to the profit, and then we consider it when computing the cash flow from financing. I will be able to explain more of that. And then number 5, let's first of all move to note number 5. Short-term deposit are deemed to be cash equivalent. So I hope you can remember under the current asset, we had the short-term deposit. We are told this should be part of the cash equivalent. And then number 6, we are given the dividends which were paid. So I think no workings which are required. So, and then I think with that now, we can proceed and prepare now our statement of cash flows as required. So let's prepare the statement of cash flows. So the name of the company here is what? The name of this company is 𝗙𝗏 Limited. So we are required to prepare the statement of cash flows, which is for the year which ended for the year which ended 31st of March 2023, 31st of March 2023, 31st of March 2023. Yes, and what we start with here, we start by determining the cash flows. The cash flows from operating activities, or basically what we abbreviated as CFO. Cash flows from operating activities. Equally here, we need to have 2 columns. And basically our figures are in million of what? Are in million of shillings. Are in million of shillings like that. Yes. So I hope you already have that. So what do we start with here? Remember, generally we start with the profit before what? Tax. But if you check on what you're given in note number 4, do we have the profit before tax? No. So what we have is the loss before tax, and therefore that's what we are going to start with here. The loss before what? Before tax. Remember, by recording that here, we say that is just a free mark. So the loss before tax. So can someone give me that figure? I see whether we have together. So how much was the loss before tax? Give me that figure. I see whether we have together. So the loss before tax is how much? Is how much? I'm given that figure as 44. Yes, it is 44. But remember, these are loss. When recording it there, you record it as a negative. Yes, and then we make a number of adjustment to this particular loss. So the first adjustment, just like what we did in our previous class, is to adjust that loss with the finance cost. With the finance cost, or basically the interest. Because generally we said we should start with the loss or profit before interest and tax. So what we have started with is the loss before tax. So to get now the loss before interest and tax, we add back the interest or the finance cost. So and the finance cost in our case is given as 24. So we add it back such that we shall have the loss before interest and tax. And then before we come to the workings we have done here, still on the face of the income statement as given in note number 4, you can see in arriving at this particular loss here of 44 million, there are a number of items, or basically we have now the interest receivable, which was added in arriving at that loss. Can you see that interest receivable of 12 million? Yes. So this particular interest receivable, this, remember we said, is not an operating income. And because it has been added in arriving at our loss there, what we need to do is we less it. And then when computing the cash flow from investing activities, we are going to consider it there because this is an income which was generated by the company from investing. From what? Investing. So therefore, what we need to do also, before we come to the note here, from that loss, we need to less the interest receivable. The interest receivable of 12. And because it has been added there, what we need to do, we less it. The figure of what? 12 million. Simply because that is not an income from what? From investing. It is not an income from operating activities. Sasa, yes, I think that's what we have. You can see already we have like 3 items. And then from there, we need to come back here. And basically, the number of items we need to pick here from the workings. So let's start with this loss on disposal. Because remember, the number of items which we consider here, maybe you can just remember that acronym. Dial G. You take for depreciation. You take for impairment loss. You take for amortization on goodwill. Sorry, amortization on intangible assets. Loss on disposal, the gain on disposal. So what we have in working one here is the loss on disposal. Loss on disposal of what? Of a plant. We know what was disposed here was plant. It was disposed at a loss of 12, which was accounted for as an expense. And because it's a non-cash item, what we do, we add it back. We add it back. That's what we have there. No other item we are taking into account here. And then in this account, what do we have? We have these depreciation. The depreciation, we have now the depreciation there. We have depreciation on land and buildings. Buildings, how much is that? 12. Equally, that figure was deducted in arriving at that. What we do, because the non-cash item, we add it back. We add it back, depreciation on added buildings. Then in this account, there is nothing we are adjusting in our profit there. But now in this account here, we have this depreciation still. Depreciation on plant. The depreciation on what? On plant. How much is it? Is a figure of 81. Equally, we add it back because it was deducted in arriving at what? At that. And basically, that is a non-cash what? Item. So I think those are some of the items we have in our workings here. So maybe you can just go through the additional information we see. Do we have any other item we need to consider here? As for note number 1, I think we have considered most of the items which are there. In note number 1. Note number 2, we have the information about the revaluation of what? Revaluation of landed buildings. I think we have considered that here. Remember, we have said revaluation loss, we don't consider it in our statement of cash flow. And then that amount of transfer of 3 million, still we don't consider it here. So note number 2 is not will not be considered. None of the item we are taking there. And then note number 3, as far as the plant is concerned, we have considered the loss on disposal of 12. And then note number what? Note number 5, I think we have taken into account a number of items there from that income statement. Note number 5 is about the short-term deposits that will still not affect this. Note 6 about dividends that will still not be considered here. So I think we are almost done here. So we have okay, we have considered this depreciation. We don't have the gain on disposal. We have the loss. Okay, maybe we can do this. We need to check whether we have amortization of intangible asset and impairment loss on goodwill. So how do you check that? We go to where we have non-current asset. Can we go to where we have non-current asset? Because I think majorly what you have dealt with in note number 1, 2, 3 is about PP. So if we go to where we have a non-current asset, can you see we have intangible assets? Can you see intangible asset? The value for intangible asset at the start 510, and then at the end 400. So we have a decrease. We have a decrease of 110. What causes the value of intangible asset to reduce? Two items. The value for intangible asset can reduce due to disposal, but if some asset were disposed, you must be given such details in the additional information. You were disposed at how much, and so on, so that you can be able to determine the gain or loss on disposal. In the additional information, there is nowhere we are told intangible asset was sold or disposed. So automatically that decrease in the value for intangible asset is due to amortization. Is due to what? Amortization. Are we together? Yes. So therefore, we also need to consider that amortization here. Amortization of intangible assets. Amortization of intangible asset. And we are saying that decrease. Can you confirm whether it is 110? Is it 110? Is it 110? Is it 110? Is it 110? Yes, it is 110. And equally, this amortization is accounted for as an expense, but a non-cash item. So we add it back now to our profit there. And then what we need to do, we get the cash flows before changes in working capital. Before changes in working capital. In working capital. So basically, if you did this paper, here there were so many free marks. Here there were so many free marks. That loss on this before tax was a free marks. The finance cost was another free marks. The interest receivable was another free mark. The loss on disposal was another free mark. Maybe you could have missed the other items here, but at least those 4 items were free marks. And remember what we say is that any question for cash flow, any correct entry you get 2 marks. 2 marks. So means that there were 8 free marks. 8 free marks. Sasa? Yes. So can you give me the net amount here? Net amount. I'm given a figure of 183. 183. And then from there we proceed and we consider changes in working capital. Here we say changes in working capital. These are other free marks. Other 3 free marks, or basically 3 free entries. If you get now these items here, and then you got those 4 items there, it means that you have 7 correct entries, which would give you a total of 14 marks. A total of 14 marks. This question had how many marks? Are they 20? No, I think it's not 20. How many marks do we have there in that question? Are they 16? Yes, 14. You can see how simple it is to get all the marks here. Okay, so let's come back here. First of all, I will be able to give you some of those particular tips in our revision in terms of how you get such free marks. So, but we consider the changes in working capital here. We said here we consider 3 items. We just need to remember that RIP, receivables, inventories, and payables, whereby you just need to determine was there an increase or decrease, and then you determine whether that increase or decrease is a cash inflow or a cash outflow. So we go to where we have current assets, and we start with inventory. Inventory at the start 420, at the end 350. So what that means is that as far as the inventory are concerned, there was decrease in what? Decrease in inventory. The decrease in the inventories or the inventory. So the inventory reduced with how much? Is that a decrease of 70? Yes. So basically, we said the reason why inventory reduces is because we sold part of the inventory. We received money, so which is a cash inflow. So then below that we have trade receivables. Trade receivables, we have an increase in trade receivables. And in this case, we say trade receivables increases because we extended more credit to our customers, which is a cash outflow. So how much is the increase in the receivables? The increase in the receivables from 372 to 808. So I'm told is 436. And basically, because this is a credit we extended to our customers, that is a cash outflow. We record it as a negative. And then from there, is there any other item we consider there? No. Unless you are given other receivables. Because we said here we consider receivables. The receivables we consider here are trade receivables and other receivables. Other receivables, in other terms, may be referred to as prepaid expenses. If you're given prepaid expenses, other receivables, you still consider them here. But interest receivable, I'll show you how you're going to use that. And the short-term deposit is a part of the cash equivalent. That's what you're told in note number 5 down there. And then bank is still part of the cash balance. And then can we go to where we have current liabilities? Current liabilities, we consider payables, trade payables, and other payables. Other payables, in other terms, can also be referred to as accrued expenses. And I think what we have there is just trade payables. Trade payables at the start 515, at the end of the year 530. It basically means that as far as the trade payables are concerned, we have an increase. An increase of what? An increase of 15. An increase of 15. So what causes payables to increase? Remember, trade payables, this is the money we expect to pay our suppliers. So the reason why that amount will increase is because our suppliers give us more credit, extended more credit to us. So to us, that is a cash what? Inflow. To us, that is a cash what? Is a cash inflow. So basically, that's how you get those particular free marks also. And we get the net amount, we take it to the last column. The net amount, we take it to the last column. How much is the net amount? How much is the net amount here? How much is the net amount? 70 net or basically cash outflow over 436 and 15. How much is the net amount here? How much is the net amount? Net amount. I'm given 351, which is a net cash outflow. I hope that is correct. Okay, so we deducted from the figure up there. We deducted from the figure up there of what? Of 183. And what do we get? What do we get? That should give us one something. We have 183 minus 351, which will give us a net cash outflow of what? Of 168 or 168. And then 2 items we less from that figure. We less interest paid or finance cost paid and the tax paid. The tax paid. For the interest paid here, we said we consider 2 items. You go to where we have current liabilities, and the current liabilities you check. Was there any accrued interest? Any accrued interest under the current liabilities? In our case, we don't have any accrued interest. We don't have any accrued what? We don't have any accrued interest, any accrued interest. But in this case, I said if you're given any accrued interest under the current liabilities, you should take the accrued interest at the start of the year. You add the interest or the finance cost for the year, which is part of the income statement. And I hope you can remember that interest here or the finance cost of 24. But there is something also you have to remember given in note number 4, down there in note number 4. We are told this particular interest here of 24, it included 2 items. It included interest expense of 18 million and a penalty of 6 million. So what we are going to consider here is the interest expense of 18 million. But it is obvious that the 2 items here of 18 and 6, they should be added back to this profit because penalty is not an operating expense and also finance cost is not an operating what? Expense. So what we consider here is the interest expense of 18. And then after adding the accrued interest at the start to the interest for the year, you less the accrued interest at the end, which we equally don't have. Whatever you get here is the interest paid. Like in our case, the interest paid is 18 million. And then now what happened to this penalty? This penalty of 6 million, these are financing cost. The reason why the company incurred that 6 million is because of redeeming the I think there is something we are told. We are told this penalty was incurred in note number 4 due to early redemption of raw notes. So when considering the amount paid on the redemption, we are going to take the cash paid to the bond holder, to the loan note holders plus the penalty. Sasa, we don't consider the penalty here. And then from there, we also need to compute the tax paid. Remember, for tax paid, you have to prepare the tax account, because the number of items we consider here are the non-current liabilities. Automatically, we have deferred tax, just like the other question. At the current liabilities, we have what? Current tax. And then we also take into account the tax in the income statement. So I think we can prepare that particular account. We can prepare that account. Where do we prepare that account? My space here. Yes, so let's just do away with one of the account here. Let's just do away with this one of these accounts, because I think we have what we needed here is this depreciation for the year. Yes, so let's do away with these account so that we prepare the tax account. We prepare the tax account. The tax account. So we start with the opening balance. So we record deferred tax and the current tax. This is the exact thing, the same thing we did in our previous class. Deferred tax at the start, current tax at the start, and then at the end of the year we do the same. Deferred tax, current tax. Can we first of all record this? We record this. So can we go to where we have the non-current liabilities? At the non-current liabilities, deferred tax at the start was how much? How much is the deferred tax at the start? Can you give me that figure? The deferred tax at the start. The deferred tax at the start is 75. Someone should not give me 225. 225 is the total. So the deferred tax at the start was 75. And then the deferred tax at the end of the year, 90. And then under the current liabilities, how much is the taxation, which is now the current tax? The current tax at the start is 110, and then at the end of the year is 15. And then what we do, we go back to the income statement. We check how much was the tax for the year. And the income statement is in note number 4, where we are given now below loss before tax. We have 2 items there. We have the income tax repayment claim. Now this is income tax which the company was claiming. Is not a income tax expense. And remember what we said is that if you're given income tax expense for the current year, then we record it here. But now if you're given an income tax claim, this is the amount of like a tax refund the company is what? Is claiming from the government. If you're given such tax claim, we don't credit it here, but what we do is that we debit it in this account. Income tax claim. But an income tax expense should be on this side. So the income tax claim for the current year was 14. And then from there we have now the deferred tax charge. The deferred tax charge, you can see that figure is a negative, is 15. Now, what we have been, or the word we used as far as the deferred tax is concerned, is deferred tax income or deferred tax expense. Now, who can tell us this figure of 15? Is it a deferred tax income or is it a deferred tax expense? What is it? Take into account it is a negative figure. In other terms, it is deducted from the loss. Is it a deferred tax income, deferred tax expense? DTY, deferred tax income, DTE, deferred tax expense. Yes, that is a deferred tax expense. Deferred tax what? Expense. So take into account is a deferred tax expense. So we record it still in this particular account, but on which side? On this side, because it's a deferred tax expense. Deferred tax expense. How much is it? 15. And then what we need to do, we balance our account. And we said that once you balance this account and you get a balancing figure, for example, on this side, it means that that is a tax refund. But if you get now a balancing figure on this side, is a tax paid. Because there are some questions, you can get a tax refund instead of a tax paid. So what will be the balancing figure in that particular account? What will be the balancing figure in this account here? The balancing figure is what? Which side is more? On the debit, we have 14, 90, and 15, which is 119. I think the debit, what we have on the credit is more, 75, 110, and 15. So it basically means that we have what? We have a tax paid of 18. I hope you can see that figure. But yes, the tax paid is 18. Tax paid is 18. Tax paid here is 18. I hope you can see we have so many figures which are similar. We have so many figures which are similar in this question. Right here, I hope you can see we have around 12 3 times. Here we have 18. Oh, sorry, this is not 18. It's not 18, it should be 81. Should be 81. Should be 81. Yes. Should be 81. 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 Okay. So can you get the net amount here? Let's get the net amount. Let's get the net amount, which is now the net cash flows from operating activities. Operating activities, I'm given a figure of what? Negative 192, negative 267, which figure is correct? 267, which is a net cash outflow. So I think we have determined now the CFO, the net cash flow from operating activities, and actually that is the point, the part which do have a lot of work, because when it comes to investing activities, I think we have everything required and also the financing. So let's proceed and determine now the net or the cash flow from what? From investing activities. Cash flows from investing activities. Cash flow from investing activities. Investing activities, which we consider here, are the assets which were acquired, the assets which were disposed or basically sold, and any income from investment. And remember, we have some interest which was received. So we just need to go through the additional information or basically to the workings. Let's just come here to the workings. In working number 1 here, we know that there was a plant which was disposed, and what we consider here is the sales proceeds. So we have this disposal of plant, and what we consider here are the proceeds. How much amount was received? the amount which was received was 15, which is a cash inflow. We record it there as a positive. And then as far as the landed buildings are concerned, we know there was acquisition. So we have acquisition of land and buildings. So the landed buildings acquired, they had a value of 110, which is a cash outflow. There was no disposal. And then here we have this plant which was acquired. So we also need to consider it here. Acquisition of a plant at an amount of 60, which is still a cash outflow, this one. And also that is given in our additional information. So there is nothing we are considering in the account which was here, the account for depreciation. I think that's what we have as far as the asset acquired, asset disposal are concerned. But we also have to remember to include now the interest received. The interest received. This interest is received from investment undertaken by the company. Interest received. And the interest received, we're not going to take the amount in the income statement because I hope you can remember under the current assets, under the current what asset, we have something called interest receivable. Can you see that interest receivable? That interest receivable is the interest the company had not received at the start and also at the end. And basically, in terms of how we deal with that interest receivable, is the same way we deal with the interest accrued at the start and also at the end. So basically, what that means is that to determine the interest received, we take the interest which was receivable at the start. At the start of the year, the company was supposed to receive an interest of 3 million. And then during the current year, how much interest was supposed to be received? The interest which was supposed to be received during the current year is the interest in the income statement. And how much is it? In note number 4, the interest which the company was supposed to receive during the current year was 12. So take the interest the company was supposed to receive at the start, plus the interest receivable during the current year. So that is the total interest the company was supposed to receive during the current year, and then deduct what the company had not received at the end. So the interest receivable at the end, which is part of the current assets, is 5. Automatically, the difference represents the interest which was received during the current what? Yeah, this will give us 15 minus 5, which will give us what? 10. So that is now the interest which was received during the current year. And basically that's how we determine that. So do we have any other item here? No, we don't have any other item we considered here. Yes, so we just need to get the net amount, we take it to the last column. So just get the net amount, we take it to the last column, so that then we proceed, determine the cash flow from financing activities. So how much is the net amount there? The net amount there, the net amount I can see still we have net cash outflows, net cash outflows of how much? Net cash outflows of how much? Of how much is of 145. 145. And now as an accountant, by now, you can see this company is not doing well. You should be able to note that this company is not doing well at all. From the information you have there, you can see one, the company was operating at losses. You can see from operating activities, there was net cash outflow. From investing activities, there is net cash outflow. It basically means that other than the company not making profit, this company liquidity-wise, it is in a poor state. This company may not be in a position to meet the short-term financial obligations as they fall what? Due. As they fall what? Due. As they fall due. Vincent, you are giving an example of which company? So I'm not mentioning names here. Okay. So then from there, what do we need to do? We need to determine the cash flow from financing activities. from financing activities. And basically you have to remember here we said that all the items now which we include here under financing activities, we get them from equity and non-current liabilities. That's what we just need to remember. All the items we include here, we get them from equity and non-current what? Liabilities. Non-current liabilities. That's why we get all the items to be included here. So what that means is that we now go straight to our statement of financial position. We start with the equity. We go straight to where we have equity. And the equity, the first item we have there is ordinary share capital. The ordinary share capital at the start 200, the ordinary share capital at the end 300. So what happened to the ordinary share capital during the current year? The ordinary share capital during the current year did what? Increase from 200 million to 300 million. What causes the share capital to increase? The share capital of the company increases due to a number of reasons. Either there was a bonus issue, there was a right issue, or there was issue of shares at full market price. If the question is silent, you assume these are shares which were issued by the company for cash. I hope you can remember the other question we did. We were told out of the shares which had been issued during the current year and which caused the ordinary share capital to increase, there was a bonus issue. And what we considered in our cash flow are the shares which were issued for cash. If the question is silent, you assume these are shares which were issued for cash. You consider them here. So we say there was issue of shares, and because they were issued in cash, that increase of 100 is a cash inflow. Then below that, we have reserves. The first reserve is a share premium, which increased from 0 to 60. So we said the reason why the share premium increases is because these shares which were issued by the company during the current year, they were issued at a premium. And still, that increase in the premium represents the cash which was received. So we record it there. And remember, those amounts are cash inflows. We record them there as a cash is positive because they are cash inflows. And then below that, we have revaluation reserve. We say the revaluation reserve is an item of equity which do not involve cash inflow or cash outflow. We don't consider it here. We ignore that. Retained earnings, we use these in terms of computing dividend paid. But we are already given the dividend paid in note number 6. So can we just take those dividend paid directly? But in this question here, you can't compute the dividends paid using the formula which I gave you in our previous class, because the account for retained earnings is affected by note number 2. There is an amount of 3 million which was transferred from revaluation reserve to retained earnings. So you can't, if you try to use the formula I gave in the previous class for computing the dividends paid, it will not give you the correct answer. You will see there is a difference of 3 million between what you'll get using that formula and what is given in note number 6 due to that item in note number 2. So what we just need to do, we just take the dividends paid in note number 6 as given by the examiner here, 25. And this is a cash outflow. We go back to where we have equity. And I think we have dealt with now the retained earnings. So basically we are through with equity. You can see all those items, you have gotten them under equity. And then we go to where we have non-current liabilities. At the non-current liabilities, what we have? We have 10% loan notes. And basically as far as the 10% loan notes, you have to remember there was some information we were given in note number 4 about the penalty on early redemption. So you can see the loan notes, their value at the start was 150, their value at the end was 0. So what causes a loan note to reduce is the redemption. Redemption is buying back. I hope you understand what you mean by redemption from what you cover in financial management. You know that once the company issues some debt instrument, like debentures, like bonds, and so on, such debt instruments have a certain life. At the end of that life, the company is required to redeem them back in terms of paying back the principal amount which was paid by the investor. So the company redeemed those particular 10% loan. So here we talk of redemption of 10% loan notes. But now the amount which was paid on redemption will be that decrease, which is 150, plus now we also include the penalty. Can you remember the penalty note number 4? The penalty of 6 million? That is the exact amount which was paid to the bondholders, 150 plus the penalty of 6. So the company repaid back an amount of 156, which is a cash outflow. Which is a cash what? Outflow. So we are through with the 12% loan notes. This should be 12% loan notes. Then we go back to where we have non-current liabilities. We have 8% variable rate loan notes. So as far as those 8% variable loan notes are concerned, you can see their value at the start was 0, but at the end of the year, their value is 160. So these are automatically loan notes which were issued during the current year. During the current what? Year. During the current year. During the current year. And basically, I'm saying that as an accountant, you can see what this company is trying to do. What this company is trying to do. The company is not doing well at all. What the company had done, the company had issued these loan notes, 12% loan notes, where the company was expected to pay an interest of 12%, but because the company is struggling financially, as you can see, what the company did is it redeemed them earlier and it was penalized. And then after redeeming them, the company issued another loan note, which is 8%. The rate of interest is lower, and also that interest is variable. It will keep on changing maybe due to a number of factors. That interest will keep on changing. So that's why I'm saying, from the information you can get from this question, you can see this company is not doing well at all. So therefore, here we can say there was issue of 8% variable rate loan notes, and they had a value of 160. They had a value of what? 160. The company, I think, raised an equivalent amount because the loan notes which were redeemed had a value of 150. The company issued other loan notes at a lower interest rate of the same amount, which is basically a cash received. Yes. So then from there, what do we have? Deferred tax. Do we consider the deferred tax here? No. So therefore, what we need to do, basically, we don't have anything else to be included here. So can we get the net amount? We take it to the last column, and then we get the net changes. Net changes in cash and cash equivalents. Net changes in cash and cash equivalent. So if you did this paper, this was a very good question. This was a very good question. It's a question you had to score 14 marks. 14 marks. 14 marks. Yes. So what is the net cash flow from financing activities? From financing activities, 139. Okay, so and then from there, you add 3 items: the net cash flow from operating activities, net cash flow from investing activities, net cash flow from what? Financing. From financing. Add all those figures. Whatever you get is known as the net changes in cash and cash equivalents. Net changes in cash and cash equivalents. Net changes in cash and cash equivalent is how much here? Yes, the net changes in cash and cash equivalent. It can't be positive 273. Yes, negative 273, or a net cash outflow what? 273. Okay, and then to this, what do we add? We add the cash and cash equivalent. Cash and cash equivalent balance brought down. So here, remember you said we consider cash in hand, cash at bank, bank overdraft, and then cash equivalent, we consider the short-term what? Investment. So what we do, first of all, can we go to where we have current asset? Current asset, we check whether we have any cash, cash in hand, cash at bank, short-term deposit, and so on. So what we take into account here at the start of the year is the bank balance at the start. The bank balance at the start was 75. We also have the short-term deposit. Short-term deposit at the start was 120. So add that. If we had cash in hand, also add it there. If we had short-term investment, also add it there. And then we go to where we have current liabilities. And I think we had an overdraft. We have an overdraft there. So what is the overdraft at the start? The overdraft at the start is 0, but that overdraft should be deducted here. You take it as a negative because this money which is owed to the bank. Owed to the bank. So you less the bank overdraft. And then we get the net amount here, which will be 195. 195. I think that is a correct figure. And then whatever you get here will be the cash and cash equivalent balance carried down. Balance carried down. First of all, what are we going to get here? Can you add the two figures? And then we confirm whether it will be the same with the figure given in the statement of financial position. Negative 273 plus positive 195 plus positive 185. That should give us what? Yes, a net cash outflow of 78. So basically, we need to confirm whether this is the same with the cash and cash equivalent as given in our statement of financial position. So what do we take here? We go to where we have current asset. We take the bank balance at the end, which is 15. The short-term deposit at the end, 32. And then we less bank overdraft of 125. So can you confirm whether whatever you get here basically should be the same with the figure we have there? It should be the same with the figure we have there. Is it the same? Is it the same? Is it the same? Are you getting negative 1, negative 78 from this? Yes, yes, yes. Yes, yes. So basically that is it. That what was required in that particular question there. But remember what we have said is that in this particular question for cash flows, because they're not performed that well, for any correct entry you have in such a question, you get 2 marks. So mean that in that question, despite having so many entries, you just needed 7 items. 7 items, you get all the 14 marks. All the 14 what? Marks. And basically you have said, for example, from where we have computation of cash flow from operating activities, you could have gotten now 7 items. Starting with the loss, adjusting that loss with interest, interest expense, interest receivable, then the loss on disposal which was provided, and the 3 items of changes in working capital. So if you got those 7 items, you had all the marks, even without coming to this part of what? Of determining the cash flow from what? Investing, and also what? Financing. So it was a good question. If you did that question, you're supposed to perform those to get those 14 marks. Sasa? Yes. So I think that is all about that particular topic. So there is another question which we have not done, the question for August 2022. That is a question which I'll give as an assignment. Equally, there are more illustrations which I've done. More illustrations which I've done. I hope you are able to take on my YouTube account. That is something I've given, I think, in our first class on this topic. You'll be able to see there is another illustration I've done there from a paper for CPAs, from a paper for financial accounting foundation level. Still, you can also go through that video so that you can be able to understand, you can get more understanding on this particular word topic. Let me see whether I can be able to get that whatever that question. That question, yes, the question which I've done there Okay, so let me confirm that. So I've done this question for December 2021, question number 3B. This is from the paper for financial accounting, foundation level. Foundation what level? So try to look on this particular question. It will help you in terms of understanding this particular what? This particular topic. So, and I think I mentioned earlier on, the name for the account is JK Accountancy. Accountancy tutorials. So if you check on this particular account there, YouTube account, you'll be able to see that video. And also I think there is a video for the other question which we did for the other question. That is a question for December 2022. So make sure you watch on this particular video here. You just download the paper from the KASNEB website, because you already have the link. Just download that paper, have the question with you, and then you see you'll be able to get the solution for that. Equally, we said once you go there, just subscribe. Just hit the subscription button, and also you like, such that once I upload another extra video, you'll automatically be what? You'll automatically be notified. Sasa? Yes. So make sure you do that. You check on that video. You'll be able to see the solution for this particular question here for December 2021, question 3B, CPA foundation level, the paper called financial accounting. Financial what? Accounting inquiry. Subscribe, and also you do what? You hit that like button. Yes. So I think for today, I want us to stop at that point. We didn't agree on the makeup class. We didn't agree on the makeup class. I had proposed we meet tomorrow early in the morning. Is that okay? I'm saying the name Pamela is this one. The name for the YouTube account is JK Accountancy Tutorials. Accountancy what? Tutorials. Just check on it right now. You'll be able to see. And then you have said hit the subscription and also the like what button. So is it okay we meet tomorrow early in the morning? 5? Yes, so let's just meet tomorrow in the morning, so that we can start on something new. So I want us, is 5 too early? What about 5:30? Which is the appropriate time here? 5:30, 5 or 6. Which is the appropriate time? So if we start at 6, we will be ending at 8. We'll be ending at 8. Most of the guys I can see they are going with 6. So let's just have the class at 6. Those will not be able to attend automatically, will be able to catch up with the video. Studio? Yes. Those will not be able to attend automatically, will be able to catch up with the video. So tomorrow, let's then meet at 6 so that we start on something new. Remember, now we are done with that topic of cash flow. So tomorrow, I think we will do something to do with agriculture accounting. How do we prepare financial statement for farming activities at the what? At the IAS 40, is it 40 or 41? 41, that is. Yes. So therefore, let's stop at that point. Have a good night. See you tomorrow at 6. I'll request Franco to create the link and then share it with us in the class WhatsApp group. So see you tomorrow at 6. Have a good night.